Hi, welcome to the next episode of the Private Companies Strategies podcast. Your hosts are Adam Diedrich, litigation partner of Aaron Fox Schiff in the Chicago office, and Bill D'Angelo in the blue shirt. I'm a corporate partner in the Los Angeles office. And Adam, our guest today, is our fellow partner, Scott Adamson, who is a corporate partner as well in the Los Angeles office of Aaron Fox Schiff. So welcome everyone and welcome Scott.
Thank you very much, Bill. Glad to participate today.
Great. Well, Adam, I know that we've been anticipating this podcast for quite a while and really happy to get started. I think we can just dive in. So Scott, I think the topic today is alternative liquidity strategies and a specific way to do that. So maybe you could give us an intro on what we're going to be talking about today, and then we can dive in.
Yeah. So our focus today is going to be on monetizing your equity in the company, and there's a number of ways to do that. Right? You could sell the company, you could do an offering, you could go public,
share buyback,
you could do a SPAC. I mean, there's a wide variety.
Although maybe not so much anymore.
The markets aren't tolerating them. But one of the strategies that's often overlooked is the sale to an ESOP. And that's what I want to talk about today. It's something that should be considered alongside the other strategies. It's something that can be a very powerful tool in the right circumstances. And really, anytime you're considering any kind of corporate liquidity strategy, you should consider an ESOP.
So for those of us who are ESOP neophytes or have never heard of it before, that are listening to the podcast, what is an ESOP?
An ESOP is a qualified plan that's designed to invest in employer securities. So it's just like a 401k or a profit sharing plan, except that it owns stock of the company.
Okay. Yeah. And who can participate in an ESOP plan?
It's a trust for the benefit of the employees of the company.
So it's a way for employees to own their own company. Another way to do it.
Yeah, it's a management buyout strategy.
All right, that's understandable to me. Is it when you say qualified plan? For those who are not ERISA lawyers or really focus on their 401k a lot, what is a qualified plan?
It's a plan that meets the qualifications of ERISA. It's a statutory plan that has certain rules and regulations governing it. And that have to be followed. They're nothing complex, but there are things like discrimination, vesting, all the ordinary things that you would think of when thinking about a qualified plan.
So before we dive into how the ESOP works in a liquidity strategy, who are the players in an ESOP? Because I'm mentioning there's a trustee, there's the employees, there's the company equity. What does that sort of universe look like before we dive into how to use it? Who is in an ESOP?
Well, it's really a fairly simple structure. The ESOP is really no different than any other party to a transaction. So you've got the company, like you would any other transaction. You've got the selling shareholders, as you would in any other transaction, and the ESOP is the buyer.
Okay.
Now, the ESOP does have a trustee, so people associate a trustee with ESOPs. And so that is another player, but it's really the person that's making the decisions on behalf of the ESOP, which is the buyer.
Do the employees who are participants in the plan elect the trustee, or are they appointed?
No, the trustee is selected by the board of directors of the company.
Oh, okay.
So the employees don't have anything to say about that.
Interesting. So what is the basic ESOP strategy in what we're calling an alternative liquidity? So you're saying it's like an MBO or a leverage buyout done by management. Only in this particular case, it's a little bit broader because it's a buyout of the company's equity by all the employees that are participating in the plan.
Yeah, all the employees would benefit by this transaction, and so it's really something that was set up to empower employee ownership of companies.
Can you have in a company that has an ESOP? Can you have shareholders of the company that are not part of the ESOP, or once it goes ESOP, all the securities are owned by the trust?
No, in fact, that's one of the reasons that people do ESOP transactions is because you can do a smaller portion of the company. It can be a minority
Okay.
position. So you can have non-ESOP shareholders that can own stock alongside the ESOP.
Okay. I didn't know that actually. In my mind, for some reason, I thought that once you did an ESOP, the ESOP owned all the securities.
No, that's not the case.
Interesting. So Adam, and if you have any questions, please jump in. Scott and Scott and I actually worked on an ESOP transaction earlier this year. But for the benefit of our listeners, what is the structure and sort of the finances behind a basic ESOP MBO?
Well, there's basically three tax benefits that ESOPs can take advantage of.
Okay.
And all the structures are focused on utilizing those tax benefits.
Okay.
And these are extremely powerful. So first of all, a C Corp, if you have stock in a C Corp is selling to the ESOP, it's treated as a deferral transaction. So it's just like a 1031 deal for real estate.
Okay.
Right, where you buy a like-kind property and you don't recognize gain in the transaction, you carry it over to a future time. In an ESOP, as long as you're selling to a qualified and acquiring qualified replacement properties, that too is deferred.
Wow.
So that's one of the key benefits. The second benefit is that the principal and interest on the transaction debt are deductible.
Okay.
Yeah, and this only applies in the C Corp context. So in the C Corp, you defer your gain under 1042, and then you can get the deduction of the principal and interest.
No maximum.
Well, there are some limitations. Yeah, we can get into that later. It gets a little bit technical. And then if you're an S Corp, you pay no federal income tax at all.
On the transaction?
No, on your earnings going forward.
On your earnings going forward.
Yeah, so there are some states where they do have a tax. California has a tax on S Corps. Of course it does. But in most states, there's no state tax. So you can have a corporation that's not paying any income tax.
That's a pretty powerful benefit. Is that the main benefit when people look at these, if they're an S Corp?
Usually people's objective is to become a 100% ESOP-owned S corporation. But these other benefits, you don't get the deferral, okay, on the sale. So it's a taxable deal.
Right. The deal itself is taxable.
Right. So
going forward, it's non-taxable.
Correct.
Okay.
So a lot of times people will start with a C Corp transaction because they want the deferral, and then they'll build up to a circumstance where they get 100% of the stock owned by the ESOP, and then they
switch over.
Yeah.
So when an ESOP owns securities in a company, before, let's say it's a mixed company system, non-ESOP shareholders and ESOP shareholder, you do the full MBO, the ESOP owns all the shares. Does the ESOP count as just a single shareholder of the plan?
Yes.
So there's one shareholder of record.
There's one shareholder of record, and so if you have a company that's got a whole bunch of employees, and if you had an individual interest in the company, you might be a 34 Act company. But you don't have to worry about that in an ESOP because an ESOP is one shareholder for securities law purposes and tax.
How does corporate governance work? Does the trustee vote that one share on all corporate issues? Do the employees have any, do they get polled, or is there any mechanism for the employees to tell the trustee, hey, we don't want to do this, we don't want to do that? Or how does that work?
Yeah, so first of all, the duty of the trustee is to maximize shareholder value. Okay, it's not to act like a union or make sure the employees are getting parental leave benefits or any of that. It's to maximize shareholder value. There are some specific circumstances where you're required to take the vote of the ESOP participant. So if you engage in a transaction essentially that involves a shareholder vote under state law, then you have to pass that vote through to the participants of the ESOP and ask for their opinion on the vote.
So like a change of control, issuance of certain types of securities, sale of substantial assets.
Sale of substantial assets in a merger, but if the ESOP is just selling its stock, that doesn't count. It doesn't count.
Scott, are there any mechanisms for the beneficiaries the employees who are invested in the ESOP to remove the trustee?
No, it's the board. It's the board's discretion. I mean, the board has the power to do that.
So the shareholders elect the board, and the members of the board could remove the trustee. Is that right?
Yes, that's right. I mean, it's a bit circular, but that's how it works.
So let's break down the basic ESOP transaction, an MBO. How is it? What does that look like? And what do you do as an M&A advisor to an ESOP MBO?
Well, my role would be to structure the transaction. So I would work with our tax group, who's expert on these matters, to make sure that the transaction is going to qualify for all of these different tax benefits. I would execute the transaction because it's basically a purchase and sale between the selling shareholders and the ESOP. And so it's really like any other corporate deal. You have to, you have a purchase agreement with reps and warranties and everything else, and it has to be negotiated with the trustee because it's supposed to be an arm's length transaction, an arm's length negotiation.
So who in a typical ESOP deal, who does Aaron Fox Schiff represent? Which party are we the counsel to?
There's a number of roles we can play.
Okay.
I mean, the most typical is to be counsel for the company in structuring these transactions and executing them. We also represent trustees from time to time. And then we also represent lenders who are engaged in ESOP transactions because there's some unique financing characteristics to these transactions that the lender would need specialized ESOP counsel, as well as counsel representing them in a senior lender capacity. And then from time to time, we may act as special counsel to the shareholders themselves.
Oh, wow.
In those circumstances where the shareholders think they want separate counsel.
So if we're counsel for the company in the standard transaction, what is the scope of our deliverables and our negotiation? We
do everything.
We do everything.
Pretty much everything.
So can you list, because some of the listeners might be, clients and friends of Adam's who mostly get exposure to us through litigation. I'm curious, what goes in that list of the main things that we would be doing and what our expertise is?
Well, we have to draft the plan and the trust.
Okay.
So we have to create the entity that is going to engage in the transaction. And that's something that we would work with our ERISA specialists in preparing. Then we would have to have a stock purchase agreement to document the transaction, right? We would have loan documents. We'd have loan documents between the company and the ESOP. So that's one nuance that we would have to deal with in an ESOP transaction, because we have to get the money from the lender, senior lender, to the company, from the company to the ESOP, so the ESOP has the cash to buy the stock.
Right.
Yes.
So when you represent companies, and they've never done an ESOP before, so everyone's fresh to the transaction, how do you pitch this? And then what are the key legal/business issues that pop up in that initial, early part of the engagement? Like someone says, hey, we're looking for an alternative way to get a liquidity event. We've heard about ESOP. We don't really know much about it. We've talked about what our deliverables are, but what do you say to the board of the company or to the employee representatives about these transactions? What are the benefits? What are the pitfalls? What comes out in that early consultation that you provide and that you want highlighted about your practice?
Yeah, well, I mean, the initial consultation, I would say, would involve walking through the tax benefits.
Okay.
We have to figure out if the company was a C Corp or an S Corp, because the tax benefits are different. We would talk about, the benefits to the employees, potentially. I mean, you do need to have a desire to benefit the employees,
right,
to make these transactions really work and become the home run that they can be. So I would walk through the ways in which the employees can benefit over time, and the cost of that benefit to the company in light of the tax benefits. So we would start to lay out the basics that would be used to start modeling the transaction.
Do you see when you do these transactions post-closing, do they tend to have better relationships with their employees than non-ESOP companies?
Yeah, there is evidence that ESOP companies perform better than non-ESOP companies.
Really? And do
Yes.
they have fewer layoffs, fewer restructurings, or that's not really something we could opine on?
There have been studies done that show that ESOP companies employees
Do better.
do better. Yeah.
What percentage would you say, if we're looking at the private company sphere in the United States, whatever that number is, I have no idea how many companies there are. My guess is they're in the millions. Like, what would you guess is the percentage of private companies or public companies?
There's about 10,000 ESOPs.
That's a lot.
Yeah. I mean, it's not a huge number
Compared to the total number of companies.
Yeah, it's a pretty small sliver.
Do you think that part of that is a lack of education?
Yes.
Or small to medium-sized businesses have no idea this benefit exists out there?
That's absolutely the case. Absolutely the case. And that's something that we could offer, is at least an introduction to, an introductory meeting with the client. And we can just explain some of the benefits and see if they have any appetite for these kinds of transactions.
10,000 means I have no idea how many private companies there are, but there's a lot. Can public companies be part public and part ESOP, or is that not possible?
Yes. I mean, historically, it was a means of consolidating control of the company, the board, because they appoint the trustee.
Right.
And so, somewhat of a friendly shareholder. But it's harder to get the tax benefits
When you're a public
company.
Is there, are there different, because I know I haven't seen these before. Are there specific SEC, like 33, 34 Act regs that apply to ESOP specifically, or is it really more about the tax structure?
It's really more about the tax structure. There are some, regs that say that, for example, we already talked about this, but that an ESOP is a single shareholder for SEC purpose. But that's it.
So you wouldn't be forced to all of a sudden become a public company because you have more than 500 or 2,000?
No, in fact, I've used an ESOP as a means of substitute benefit for an option plan where the company had, at the time, there was a 500 shareholder limit, but they had options that were likely to be in excess of 500 shareholders. So they used the ESOP as a means to buy back the shares so that they could continue to provide equity benefit, but not have the risk of the options becoming 34 Act compliant.
So one of the questions I have just sitting here talking about it, and I don't know about you, Adam, is when you do an ESOP, do the employees get their percentage of the ESOP ownership based on, like if there's 500 employees, each one gets one 500th? Or how does that work? Can different employees have different ownership percentages of the ESOP?
Yes, it's based upon compensation.
It's based on compensation?
Yes, how much you're making.
So if the CEO is making 10 million and the average worker is making 50,000,
well, there's limits.
There's caps.
There's caps, right? So it's something like 290,000. Yeah, it's not. So this is not a benefit to the highly compensated employees.
They're not going to look at this and say, "This is great for me."
Right. So, but you can have an ESOP alongside any other
ownership structure.
Right. So what people do is you'll have a synthetic equity plan. You'll have a SAR plan, most typically, and you'll give SARs out to your key management,
so they can be compensated for the full tilt.
Yes.
Okay.
Yes.
Interesting.
Yes. Now that's taxable, but it's free. So
on a SAR like that, a stock appreciation right, for those who don't know what a SAR is, do most SARs pay out contractually at the end of each year, or how does the SAR work in conjunction with an ESOP?
Typically, it would pay out on a change of control. I mean, that's up to what's negotiated.
Right.
But it could be more frequent. That's possible. It really just depends on the overall objectives of the company and how the deal is structured.
So besides the tax benefit and the corporate governance benefit, is there anything else, like when you're advising a company, maybe it's unionized, maybe it's got a strong managerial group, what specific issues other than tax come up when employees are considering an ESOP? Like, what are they like? They're like, okay, I understand there's a tax benefit. I understand there's deferred taxation depending on whether it's a C or an S corp. But in your experience, are there things that keep coming up over and over again that counsel for the employees ask?
Well, I mean, typically, the employees don't have counsel. I mean, normally this is something that the company really has to sell to the employees, being a benefit, something useful to them, and that they're excited about. They can build equity value over time, and that aligns the interests of management and the employee. But to answer your question, for example, unions historically have not been super friendly, and so it's possible to exclude union employees and let them have their own plan, and they just don't participate. So, I mean,
Wow.
the discussion that you raised it's certainly an issue as to who actually gets to benefit.
But there's fewer and fewer companies that are under collective bargaining, I would imagine.
Yeah, I mean, no, I've only seen unions a handful of times in my practice.
Scott, I'm thinking about this from. Oh, sorry. Go ahead, Bill.
Go ahead, Adam. I'm done.
I'm thinking about this from the perspective of a business owner who is not a lawyer. Is it typically a business owner who would initiate the process of forming an ESOP?
Yes. I mean, it would be the business owner, it would be the company, but it would be the business owner as the majority shareholder working with the company to execute this plan.
Sorry, keep going.
I was going to say, these are not mom and pop businesses. I mean, they have to be of a certain size to make them worthwhile. And what size is that? Well, it just really depends on how much tax benefit there is versus the transaction costs. So these deals can be pricey because there's a lot of moving parts, but not any more price than anything else. But legal fees are important.
So let's say I'm a business owner, and I've heard generally about the possibility of doing an ESOP. Could you walk me through very generally what the various steps are in the process? What do we begin with? Say from the first meeting with the company's lawyers, and then how long does it take, and what do we end with?
Well, I think we would want to, as a first step, get a financial advisor involved to help model all of this, because there's a lot of different variables that can affect the overall performance. So we would want to develop a very detailed model of what this is going to look like for the company, which would not be something typically that the lawyer would take charge of. We would be involved in it and can add value there, but we would want to make sure that we had somebody to help us out with the modeling.
Okay. So what happens if the financial advisor says that an ESOP could be a good idea? What happens next?
Well, we would have to finance the transaction. So that would be the next step, would be to identify a financing source. Before we went and executed on the transaction, we would want to make sure there was a lender that had an appetite for the transaction.
And can you explain what the financing is for? Who borrows it, and who gets paid out?
Yeah, so I mean, there's really not a whole lot of difference between financing an ESOP transaction and financing a company generally. I mean, it's the same methodology. It's how much debt can the company support? That's really the primary consideration. So you go to your lender, you say, here's my financials. Lender comes back and says, we'll loan you X dollars. So that's the first step and the first part of the process that we would help initiate and execute.
So if the financing is obtained, the company borrows the money,
yes.
and then lends the money to the ESOP. Is that right?
Yeah. So the company borrows the money from a lender, just like any other transaction. It takes the money, it loans it to the ESOP, and then the ESOP takes the cash and gives it to the selling shareholders. That's the basic structure. So it's really like any other LBO transaction. It's just you've got this one additional step in the middle.
Okay,
yeah, I'm sorry.
Go ahead, Bill.
No, go ahead.
I just wanted to finish then the steps in the process. So I'm a business owner. I got a lawyer who's helping me out with a potential ESOP. We have a financial advisor who says this may be a good idea. We line up our financing. What happens next?
we would have to identify a trustee and engage a trustee.
And who does that? Who finds the trustee?
Well, the company is supposed to do it.
But in reality, does council often have a stable of trustees that do this work?
Well, the DOL is very aggressive about how the trustee is selected, and so there has to be a process by which the trustee is selected. It has to be something that is something that is actually conducted, and to identify a trustee. So you would want to go out to more than one and have a reasoned process to select the trustee that you chose, and we would want to document that.
Are trustees compensating?
Yes.
Well,
Depends on your perspective, I guess.
okay.
Yeah, I mean,
is it like a salary, like a CEO's kind of?
no. Trustee, you pay him a transaction fee, and they'll get a fee on an ongoing basis to administer the ESOP.
Kind of like directors in a public company who get cash, but they're not actually managing the company day to day.
Yeah, it is an additional expense, but it's nothing unmanageable.
Do ESOPs, because they're leveraged deals, do you see in your practice, like back in the day, a lot of LBOs went sideways and couldn't pay the money back. What happens if that situation arises in an ESOP debt-funded transaction?
Well, most of the deals that I've worked on historically, there haven't been financial issues, and that's because if you have the right team in place,
you won't over-lever.
You won't over-lever, and the transaction will make sense. But and I thought, frankly, during the last financial crisis that we would see a lot of stress in the ESOP community because of the fact that these transactions are so highly levered in the beginning. But it didn't happen.
Interesting.
So we of course have a bankruptcy group here, and we're positioned to handle any kind of financial stress that a company might be enduring. But the issues are basically the same as a non.
What is when you look at these loans, which I'm sure you participate in negotiating, what is the time frame and the sort of interest rate structure that are paid on these MBO financing facilities?
Well, typically they'd be a
15
term piece, right, which
Term.
is what would be used to actually acquire the stock, and then there would be a revolver for working capital. The terms are flexible. I would say 10 to 20 years.
Yeah, so it's a good layout of time.
Yeah.
And how, I know none of us are tax lawyers in this call, but when the money's borrowed by the company, which is then lent into the ESOP, I'm assuming it's the cash flow of the company that supports the loan.
Absolutely, yes. Yeah, so it's really similar to any financing. If the company has cash flow, it can get a loan. If it doesn't, it can't.
Can the board can the board have discretion on how they spend that money? So are there situations where the ESOP itself is unable to pay back? I guess I'm trying to understand, so the company borrows the money. The company then lends the money to the ESOP to buy the shares of the company from its shareholders. How does that structure work?
Here's the piece that I think we need to talk about, and that is that when the company lends the money to the ESOP, it takes as security the shares of the ESOPs acquired.
Okay. All right.
And then, in addition to that, the loan will not default unless the company contributes money to repay the loan.
Right.
So that's how it works, and that's where you get the deductibility of the principal and interest, because the entire amount of that payment is deductible as a compensation expense. Wow. And so that's where that,
because otherwise corporate debt is not deductible.
Correct.
Yeah.
It's not.
Interesting.
And that's in the C corp only.
Right, in the C corp context, because S corp is totally different.
Yes.
I mean, that's a huge benefit. I mean, I remember that wasn't it an issue in the 80s and the 90s about that one of the drivers of LBOs was the deductibility of the acquisition financing, and then that was taken away.
Yeah.
By the IRS.
Yeah. No, the acquisition financing is definitely deductible here. I mean, there's some limits on it, but it is deductible.
When someone, if a client comes to you and says, as Adam just was talking about, and they say, I want to do an ESOP, are there ever any times when you say to someone, I don't think you should do an ESOP? Is there anything that pops up where you're like, this would be too risky to do?
Maybe not too risky, but it may not align with the objectives of the company. I mean, or the seller. So if the seller wants out and wants to walk away from the business and go to the Bahamas and spend his money, this isn't the transaction for him, because there's going to be typically in these deals some subordinate notes, right, to fill the gap between what you can borrow from the senior lender and how much cash you want in the deal, and those notes basically mean that the selling shareholder has to remain involved in the business because they want to make sure the business succeeds so the note gets paid back.
Who are the, is it private equity that does most of these subordinated notes, or?
No, I'm talking about from the sellers themselves.
Oh, okay.
Yeah, but there are circumstances where there are funds, non-banks, that do make these loans. That'll make either a combined loan or a mezz loan, basically.
Right.
So that when, to the extent that private equity is involved, it's not on the equity side typically.
It's on the debt side.
It's on the debt side. But in a mature transaction, there may be an opportunity for private equity.
So one of the things we haven't talked about are, for people like Adam and myself, I mean, I know I've helped you out in one transaction. What are some of the things, because people always bring in their own prejudices and thoughts about things. Mm-hmm. Are there things about ESOPs that are misconceptions or misunderstood that you'd want to disavow people of that, so that the ESOP is a transaction that's on the table? What are some of the things that people mistake about, because like when we were talking before the audio started, I mentioned to you like my one connection, mainly because I had a friend who was a United Airlines pilot, but I remember United Airlines ESOP, which I think at the time was the largest ESOP. What are some things that either employees or managers think they know, but they don't really know, or they've made a mistake?
Yeah, so some of them we've alluded to already today, but the first that comes to mind is that the employees will run the company.
Which
right?
Is not
this structure somehow gives the employees some sort of additional role in management, and that's not true.
Except in very limited circumstances.
Yes, there are some circumstances where they have to vote, but and even then, by the way, and this is probably beyond the scope of this call, but there'd be a trustee override. So you could potentially have a situation where
you vote one way,
right, and the trust says, "Yeah, I don't think that's in your interest."
Oh, okay.
So I've never seen that happen, by the way.
But it's theoretically possible.
Yes, it is. Yes.
Okay.
Another is that the employees are going to have all sorts of know everything about the company, what's going on, and people are concerned about that. And that too is a misconception, because the only thing that the employees know is they get their annual statement of the value of their ESOP. So it's very much like a mutual fund.
Okay.
You just get a statement every year, and it tells you how much your stock is worth, and that's it. And there's nothing else that the employee is going to know beyond what they know in any company other than that value.
I don't want to derail from the misconception, but I do have a question that I think if I were an ESOP participant, how do I get liquidity from my position in the ESOP?
Death, disability, or retirement.
Death, so it's an ERISA type structure.
Yeah. So when death, disability, retirement, and then you get.
So who pays me? So let's just take like Adam and I are both employees in your clients. We're participants in an ESOP. We both retire. We're not going to die. We retire. Who funds that payout? Is the company just funds it from cash flow?
Yes. Yeah. There typically is some thought around how much it's going to be and who's going to leave and all that. And lenders will actually want to make sure that the company has means to pay that amount
as it comes due.
And normally that comes from the company in some way, shape, or form.
And I know, again, I want to get back to misconceptions, but one of the things you and I have talked about offline without Adam is the ESOP structure. One of the benefits for the employees is it's a massive way to build wealth.
Yes. Right. It means you don't pay for the interest in the company. It's given to you.
Right.
And, it's built its value tax-free.
Over time.
And yeah, this can be an extremely powerful benefit.
Make a
for
lot of
employees.
employees rich.
Yes, I mean I've had clients who have, the secretaries have $1 million in their account.
Why don't more people know about this, given that it's such a wealth builder?
I don't know. I think we just need to educate more people about it. And now that we're going to have the the gray tsunami is supposedly coming, and hopefully there'll be more ESOPs.
So getting back to the misconceptions, we talked about this earlier in the podcast, but if I'm a highly compensated, let's say, maybe just below C-level, C-suite, or maybe I'm in the C-suite, does it still make sense for me to be in favor of a structure like this?
Sure. Why not? If you're not paying anything for the stock, it's only a
free.
benefit to you. I guess the one downside is that companies tend to think of this as a benefit that can be substituted for another benefit.
Okay.
So that would be a potential negative.
What do you think is the biggest, if we haven't mentioned it already, what is the biggest misconception about ESOPs that may make people, toss them out of hand before it's fully considered or before they even get to Aaron Fox-Schiff and Scott Adamson?
It's just a lack of education. It's a lack of understanding. They'll say that the deal's just too complex. There'll be some sort of anecdote about, some deal that couldn't get done, or who knows. But bottom line is, if you have the right team in place, there's nothing that's going to stop the transaction.
What are there any anecdotes that you can keep the client name out of where you were surprised at how successful the transaction was? And maybe give our listeners and some of the clients that'll be watching this, like, what are the levels of financial return that these kind of deals generate, like the typical deal? I know that's hard to say, but you've been doing this a very long time, so you have a large stable of deals in your background.
I mean, again, when the deals work, and they can work in a way that's extraordinarily beneficial for the plan participant. And again, I have circumstances where the lower level employees have $1 million on their retirement.
So people are looking at doing this. When you are advising boards on whether or not to do an ESOP, are there any features of companies that make them good candidates for being ESOPs? And is there something, like, in your experience, an algorithm that says this is going to be good, this is not going to be good?
Yeah, I mean, the first thing you have to have is leverageable cash flow.
You have to have money.
You have to have money coming in so that you can borrow money.
So this might not work for earlier stage companies, which are not. These are more mature businesses.
Well, and you asked why don't we have more ESOPs? And one of the answers is that it doesn't really fit the Silicon Valley business model.
Right, which are equity growth versus cash flow.
Right. So there's a lot of industries where there's no, it's not a favored strategy, right, because it doesn't have the characteristics that you would need.
So the first one is cash flow.
Yes.
The most important one is cash flow. Are there any other things that you say, oh, I'm looking at the company, you guys are a good candidate? What are the other features of a good ESOP candidate?
Well, you see a lot of these in service businesses that are highly dependent on their employees, because it's hard to sell a service business in many cases, because the value of the company can walk out the door.
Right.
So this is a way of locking in the employees to the company. So you see ESOPs in service businesses probably more than any other. And for example, construction is one where you'll see a lot of ESOPs.
Really?
Yeah,
why in construction?
Because construction companies are hard to sell. They're for the same reason that their value is really dependent on the people that work there.
Right.
And the people are highly mobile, and they move from company to company. And so, it's very difficult to sell a construction company. But you see a lot of construction companies in the ESOP space are using ESOPs because the ESOP will bind the employees to the company.
Okay. We talked about the general tax advantage liquidity. What is a busted S corp's auction? in connection with an ESOP?
Well, if you're selling a company, that for whatever reason the deal doesn't close, then the ESOP can come in and be a potential way to get some liquidity for those owners.
Okay.
I mean, it's just a perfect sort of setup.
Do you see that happening quite often?
Yeah, I mean, it happens.
Yeah.
If you were to talk about circumstances in which it would be an ideal transaction, that would be one
of them.
Yes.
You mentioned construction, you mentioned service businesses. Are there any other, obviously not Silicon Valley tech-based companies, which are growth versus cash flow. Are there any other, does transportation, or are there any other such sectors where you're like, wow, over the last 30 years, I've done a lot of deals in this space?
I think we've touched on it. I've done quite a bit in the medical space.
Like doctor groups?
Yes. Doctor groups, physician groups, dentists. There's a lot. It's a popular structure there.
Is there an ideal size of the number of employees for an ESOP?
Well, the more employees you have, the bigger the deduction for employee compensation because of the limits that we talked about earlier. Right. So, companies that have a large payroll, and again, a number of employees that are highly mobile, that's a good fact for an ESOP transaction.
Because it reduces, because of the way the ESOP structured, it reduces the incentive to relieve, and it creates this lifelong commitment to the company. So it's a win-win for the employees, and it's a win-win for a company where the talent can walk out the door any day. Right. It's like a golden handcuff in a sense.
Yes, absolutely.
Do you see it at all? Have you ever seen it with Hollywood talent agencies or anything like that? Have there been any in that space? I'm just thinking in terms of industries that I deal with that are highly service oriented or law.
Well, there was a highly successful example that was in the payroll processing business.
Okay.
Yeah, and that company sold for quite a bit of money and made a lot of people very, very wealthy.
Adam, do you have, from a litigator standpoint, do ESOP deals get litigated? Do they go sideways? Historically, like the old LBOs, there'd be tons of litigation around. That's how Wachtell Lipton made its mark, was being involved in LBO litigation. Do you see ESOP deals going south and ending up in litigation, or if they?
No. I think the litigation comes from the Department of Labor, and they're concerned about how these transactions are structured. But if you structure them right, you can navigate that in the way.
What is the department? So let's take a deal where the Department of Labor takes an interest in it. What would get them all hot and bothered about getting sideways with the management and an ESOP? What
the value of the stocks dropped? That would be the most significant. So if you see, a large drop in the value of the stock, then they're saying, hey, this is a retirement plan. You bought the stock for $100 and now it's worth far less. What's going on?
And have you been in situations where we've been engaged those types of defense?
Yeah.
Yeah. And maybe Adam, you have some insight in this, but are there, when the stock drops, what's the claim the Department of Labor is making? Is it a fraud claim? Is it a mismanagement claim?
Well, it's that the trust overpaid.
That the trust overpaid.
Mm-hmm.
And
because when the trust engages in a transaction, it has to have an opinion. It has to have a financial advisor,
right,
that advises it that the trust is not overpaying for the stock.
Okay. So when you get a financial advisor who's key to the structure and making sure that the price is being paid, not too much, not too little, when you're in the process of engaging the financial advisor, are they generally traditional investment banks, or are they specialty houses? Who does that kind of work?
Well, we're talking about two different things here. So the financial advisor to the trustee is one. So okay, that's separate from the financial advisor I was talking about earlier in this discussion to the company. You may have transactions where you don't have two financial advisors, but in my experience, it's better to have a financial advisor to advise the company and the shareholders with respect to the long-term.
And are
aspects
those
of the
mostly what we
transaction.
would consider traditional investment banks, or are there?
No, there's specialty groups out there. They're primarily specialty investment banks. They typically have what we would call traditional investment banking arms, but their focus is on ESOP transactions.
For people that do this financial advisory work, is it your experience that they're licensed broker dealers, or just for this type of transaction, that's probably not necessary?
I would say that they were broker
most
dealers.
of the time.
Yeah. I think the unlicensed broker dealers aren't really doing ESOP transactions.
Because they're very specialized, they require a lot of expertise.
Mm-hmm. Yes.
Yeah. If you could say like just a handful of things to people who are listening here, this is their first exposure to the ESOP, what would you want to communicate? Since we're really showcasing your practice, what have we not covered so far that you think people need to know about in an ESOP?
Well, I think what we started with, I think that the ESOP needs to be a transaction structure that is considered, at least considered, and it should be part of the dialogue anytime a company wants to engage in a liquidity transaction, whether that's a recap, a sale, whatever it is. There should also be a discussion about ESOPs and the advantages of the ESOP. It may not be the best, but if it is, it's going to really, really be a good deal for people.
What's again, without naming client names, what's the best ESOP deal you think you've ever worked on that turned out where people were like 10 years later, like, oh my God, this is the best thing you've ever done since sliced bread?
Well, you want them to overperform, and so if the company performs better than what the financial advisors were, then that's always a home run.
Do you see downstream M&A deals where the ESOP sells its one share in the company in an M&A transaction? When does that ever happen? If it doesn't, how? If not,
well, you can sell a company just like any other. And so if you have an ESOP sale transaction, that's a place where Baron Fox would play a key role because of our expertise. But you take the company to market, you put together a SIM, you'd get your bids, your indications of interest, you'd get your bids, and you would execute a transaction just like any other. The only difference is you have to get the ESOP trustee on board.
Right, trustee to approve.
But that's not anything that's insurmountable.
But doing a post ESOP M&A deal or liquidity, so a second liquidity event, that would trigger the valuation because it's a liquidity event, that would trigger the valuation of your underlying shares.
Yes.
And then people would the employees, after paying back the debt, would get a payout.
Yes.
Does that happen very often?
Yeah.
It does.
Sure. So, these are perfectly good companies, just like anything else. I'd say there's a heightened interest in ESOP companies, in part because until recently the market's been so heated that people want to look at deals that others are not looking at, and so there were a lot of transactions, sell-side transactions of ESOP companies.
The two of the three of us partners on this call today are California lawyers, and one of the things that I hear in my early stage practice is, should I be a California company? Should I be a Delaware company? Are there any, other than the tax, are there any benefits to being in a specific jurisdiction for the ESOP company? You say before we do this deal, you should change from California to Delaware and do a conversion. Do those issues ever come up in transactions? Are there benefits for being in one state or another from a corporate governance perspective?
Well, as it's pretty difficult to do a transaction in any state other than Delaware.
Right.
So I would advise any client that was going to do an ESOP transaction that we should move the company to Delaware. Yeah. Okay. But that's not because there's special benefits to Delaware. It's just
the overall.
Yeah, you can file documents the same day, and ease of use is very, very significant.
I always advise people, unless it's a single member LLC, not to do California entities. Is there how do I say this? We talked about the tax benefit, we talked about the structure, we talked about the pitfalls, we talked about the misconceptions. We went through Adam's questions on how a deal gets done on a sequential basis. What draws you to ESOP deals as a lawyer? I mean, some people like, some tax lawyers like analysis. Some people are, they like working with early stage tech companies because of the excitement of the newness of what they're doing. What drives your enthusiasm for the ESOP space?
Well, I think it's a great structure, and it benefits the employees, and there's some satisfaction in helping people out. Yeah. I mean, these transactions, they're less negotiation, more structuring and tax benefits and all that, and that can be very interesting as well. I guess one thing too that we should probably add before we conclude, that's a significant benefit to the structure is that in many of these transactions, there's significant warrants that are given out.
We talked about that in the past.
Yeah. So one of the benefits is the second bite at the apple. So you can sell the company, you get some warrants, company grows.
Sell it again.
Yeah.
Adam, do you have any follow-up questions? I think we've gone, past our 30-minute budget for our PCG Strategies podcast. I think it's been a great episode, but I want to make sure that Adam, if you have any additional questions, so we get them out for Scott, help him showcase his practice, showcase the expertise of our firm in doing these types of transactions.
I think we covered a lot of detail today. I could imagine there being more specialized focused in the future podcast on some aspects of these transactions, but I think this is a great start.
Yeah, I agree. Well, Scott, it's been great having you on the Private Company Strategy podcast. For those of you who may not see it, Scott and I have a Corporate Corner podcast, which is based out of the LA office and is released mostly once a month, and we'll keep you apprised of those. But just, Scott and I do a separate podcast, and we'd love to have you follow us too. Adam, thank you for dialing in remotely. Thank you, Scott, for being part of the podcast, and we look forward to the next episode. Thank you very much.
Thank you.
Thanks, Bill. Thanks, Scott.
Mary, how long was that?
Too long.